Chances are you were invited to view this presentation by a financial professional that is looking to educate and teach you the facts about life settlements. Our goal over the next 20 minutes is to turn your interest into knowledge as you learn the ins and outs of an industry on the rise. The purpose of this video is strictly educational and is not intended to solicit business or offer any product or service. This presentation is intended to provide a high-level overview, so if you have any additional questions following this presentation, please contact the financial professional who sent you here to watch this. The world is a big place, and so are the many investment options we have at our fingertips. Investing in something outside of the traditional stocks, bonds, mutual funds, or real estate for most Americans is a place we don't dare go. Why? Because we're comfortable with the strategies we know. If I mention REITs, currency, or options, most people would recognize these as strategies we don't know, and certainly not be as comfortable with these strategies. Lastly, the biggest slice of our investment knowledge are the strategies we don't even know we don't know, the big world of the unknown. This represents all the strategies we've never been properly introduced to. When it comes to life settlements, there's a very good reason most Americans have never heard of this unique and powerful asset class. Here is why. Life settlements have been available for over 20 years, but over 95% of the $50 billion life settlement industry is owned and controlled by major institutions. And most financial advisors across America are unable to offer this investment to their clients. This, by default, is a strategy most investors don't know they don't know, meaning they've had little or no exposure to it whatsoever. Our objective now is to educate you on the facts about life settlements, making it a strategy you know. So let's start out quickly getting a good understanding of what a life settlement investment really is. As you'll see here, the definition is pretty simple: a purchase of an existing life insurance policy at a discount to its face amount. So what does that really mean? Let's just say, for example, Mr. Jones is 65 years old. He owns a $10 million business, and for estate planning purposes, he goes out and purchases a $5 million life insurance policy, a very common practice for a business owner. He spends a lot of money on this policy over the years, but it protects him, his assets, and his family estate. Fast forward, say, 20 years. Mr. Jones is 85. He's sold his business, so he is no longer in need of this large, expensive insurance policy. And instead of lapsing the policy, he uses a broker, very similar to a real estate transaction, and sells his policy. If he lapsed it, he would receive nothing, not a penny. Now, if he had built up cash value, of course, he would have cashed that amount out. But instead, his broker finds a buyer willing to pay him 4 times what his cash surrender value is. Now, obviously, Mr. Jones is ecstatic and accepts the offer. The total acquisition cost or purchase price for the policy is $2.5 million. The investor could be a hedge fund, pension plan, investment bank, a fund, or an actual individual. Of course, the new owners of the policy are now responsible for the premium payments, just like you would be when you own your own life insurance on yourself. Premium payments are to life settlements like real estate taxes are to real estate. Now, of course, no one likes to pay taxes, but we do and continue to invest in real estate. Life insurance premiums work the exact same way. Now, Mr. Jones, who lived a great life, ends up passing away at age 90. At that point, the investors would receive the death benefit. Pretty simple, right? Win for Mr. Jones, who was able to discreetly liquidate an asset, receiving much more than the insurance company was willing to offer. And certainly a win for the investors. Their combined $2.5 million turned to $5 million in 5 years. Now, it may have gone longer, and in that case, the investors would be required to pay additional premiums, reducing their overall return. But because it was purchased correctly up front, like a good real estate investment, it would typically take 8 to 12 years of paying premiums before investors would eat into their principal. At that point, Mr. Jones would have been 93 to 97 years old. Now, is that possible? Well, sure it is, but it's not probable based on the medical underwriting of this policy. This is an example of purchasing one single policy, which is not real common. In most cases, investors want to invest in multiple policies to increase their level of diversification. We'll discuss the various investment structures here shortly. There are two sides of the life settlement industry. The one side helps seniors sell an asset they no longer need or want, offering them more than their cash surrender value, providing a cash infusion most never knew existed. The other side of the life settlement industry is the funding or investing side. In other words, individuals or institutions investing in a policy, or in most cases a portfolio of policies, holding those policies for a varied period of time and receiving a payout as policies mature. Although it's important to understand both sides of this asset class, today we'll primarily focus on the investment side of life settlements. Many people find it important to understand what is actually motivating someone to sell their policy. For starters, a life settlement transaction is a pretty sophisticated transaction, and so are the policyholders who are selling their policies. 80+ years old is typically the right age to purchase a life settlement because the hold period tends to be shorter. Ideally, a life settlement investor should be in search of a 4 to 10-year payout window, and purchasing policies of 80+-year-olds in your portfolio will minimize your exposure to longevity. So why would an 80-year-old sell their policy? It really boils down to 3 reasons. They either no longer want or need the coverage, they'll use the money to better their retirement, or they may get to the point where they can't afford the coverage. Bottom line is, the policy they have in their hands has virtually outlived its usefulness, but has tons of value. Of course, there are times when people will ask, how is this legal? Well, here we are 2 decades later and $50 billion in business has been transacted. So you know it's legal, but what makes this a legal transaction? In 1911, the Supreme Court ruled in a case called Grigsby versus Russell. This ruling enabled policyholders to sell their life insurance policy because it was deemed to be their personal property, just like a home, a car, a watch, or anything they own. An insurance policy is yours, and you can basically do anything you want with it. Interestingly, it took about 80 years after this ruling before an industry was created, making this the insurance company's best-kept secret. The life settlement industry is a dynamic one. You may ask, how and when did this industry begin? If we back up the clocks 25 years to the early 1990s, the industry started with what was called viaticals. As you recall, back in the late 80s and early 90s, AIDS was starting to inflict millions of people. Unfortunately for the victims and their families, it was the closest thing to a death sentence as you were going to get. Those who contracted AIDS were typically younger, didn't have much of an estate, but owned smaller life insurance policies. So the viaticals were quite similar to a senior life settlement, but the insureds were much younger and the life expectancies were typically around 2 years because many were terminally ill. The insureds absolutely loved the option of selling their policy because this gave them a cash infusion, enabling them to be more comfortable in their remaining years. During the mid-1990s, many drugs started to enter the market, not curing the disease, but treating it, allowing many who were HIV positive to live much longer. Well, this made predicting life expectancies on 20 and 30-year-olds quite difficult. So by the mid to late 90s, viaticals had pretty much disappeared. By the late 1990s, a new yet similar asset class was created called life settlements. There were 2 big fundamental differences between life settlements and viaticals. Life settlement policies were much larger, and the age of the insureds were much older, making the life expectancy more predictable. Like most new asset classes, there were the initial hurdles to overcome. One was, and still is, the lack of public awareness that a senior could actually sell their policy. As the industry grew in the late 90s and 2000s, companies called life settlement providers became state licensed and acted in a similar fashion as title companies did in a real estate transaction. Closing policies using a licensed provider became critical due to the high level of due diligence providers underwent to ensure policies would pay out to investors. Servicing companies also became a critical component to a life settlement transaction. Companies like 21st Services and ABS, who conduct medical underwriting, policy optimization, and insured tracking, grew rapidly due to the billions of dollars being invested into the life settlement market. Today, industry experts estimate the life settlement industry is around $50 billion. Still relatively small, but definitely on the rise as more and more seniors uncover the hidden wealth within their life insurance policies. As more and more awareness continues to grow about life settlements, it is becoming quite popular among mid to high net worth investors as the ultimate alternative investment, due to the fact it's completely uncorrelated to stocks, bonds, real estate, and even geopolitical events. So what's happening right now with the life settlement industry? Well, it's growing, and for good reason, because policyholders are recognizing the paper their insurance policy is written on actually has value. Older insureds don't have to see lapsing their policy as the only option. It's also growing because many people are so tired of their hard-earned retirement dollars being played with in the market. Many feel as if they're going to Vegas with their retirement because the fundamentals that made Wall Street what it was make very little sense today. Billions upon billions sit in IRAs and 401ks and are at the complete mercy of market forces and not the fundamentals of companies they're investing in, like the good old days. The markets today don't make sense. They are completely unpredictable, and there is no doubt the individual investor has a disadvantage over the major institutions. Another reason for growth in this industry, especially over the past 5 years or so, is due to an increased level of regulation. The right amount of regulation is necessary for any investment to thrive and for investors to gain the proper level of confidence needed. Many are surprised when they understand who the key players are within the life settlement industry. The biggest purchaser of life settlements are actually insurance companies. Now, this doesn't make any sense, right? Or does it? Of course, the insurance companies know all too well how the strategy works, so they're going out and purchasing policies from other insurance companies. AIG is a perfect example of this, and they own literally billions of dollars of life settlements. Investment banks, hedge funds, pension funds, some very recognizable names, Bill Gates and Warren Buffett, have massive portfolios of life settlements. When you take a look around the industry and identify how investors can invest in life settlements, there are typically three structures that exist. The first is investing through a private placement. This is not a mutual fund, but many people see the similarity. This is taking a portfolio of policies, it might be 10 to 100 different policies, and packaging them into a life settlement fund. The investor would then buy in, owning a percentage of the fund based on their invested amount. A real advantage to this structure is that in most cases there is a premium reserve established, which greatly reduces the likelihood of an investor coming out of pocket later for additional premium payments. The downside of investing in any form of life settlements is the lack of liquidity until a policy matures. It's a fantastic growth vehicle, but you must have the time horizon available to let the investment play out over time. A typical fund will purchase more policies, therefore creating more diversification than one could afford to purchase on their own, making the fund a solid choice for mid to high net worth investors. The last two options are typically designed for high net worth individuals, pensions, or institutions. As I mentioned before, this is where the vast majority of the entire life settlement industry operates due to the large capital requirements in order to purchase a portfolio of policies all on their own. So what are the exact characteristics that draw institutions and individual investors to life settlements? Life settlements derive their low risk due to the fact they are backed by top-rated insurance companies. Most Americans own life insurance on themselves or a family member. When this insurance is purchased, there's typically never a question whether or not the death benefit will pay out as we're purchasing the coverage. This is for good reason. Life insurance companies have earned this reputation because they've always paid out on their claims. This characteristic alone makes life settlements a solid choice for qualified candidates who understand or believe in life insurance. The key characteristic investors appreciate the most is the fact their investment is completely 100% uncorrelated to stocks, bonds, mutual funds, interest rates, and geopolitical events. Time is the only factor that affects life settlements. Having a portion of your portfolio disconnected from the market can play a big role in your financial recovery following a correction or crash. Everyone knows the importance of diversification, but Americans rarely achieve true diversification away from the markets since the majority of our investments are tied to the market, and investment in life settlements provide an exception to this rule. Since there is a 4 to 10 year payout window associated with life settlements, investors must take a long-term view when investing. This is why many will invest IRA money into life settlements, since we typically view our IRA dollars as money we want to touch down the road during retirement or to grow for our kids or grandkids. There are income strategies and there are growth strategies. Life settlements are definitely a growth strategy and must be handled as such. A buy and hold mindset is required when investing in life settlements. Longevity risks pertain to the fact that there will be policies that extend beyond their life expectancies. Using life settlements, there is a known payout on all policies purchased, eliminating the uncertainty many investments possess. For example, we know our $200,000 investment will pay out to $360,000. We just don't know when. No parity of risk is hard to find in the world of investing, but does exist with life settlements. No parity of risk means you don't have to take on additional risk to reach a higher return. Most investments do have a parity of risk. Think of a money market account, low risk and low return. Since life settlements have a known payout and aren't subject to market volatility, they provide a higher return with lower risk. Premium calls are to life settlements like real estate taxes are to real estate. Premium calls are unavoidable, and every investor must understand the potential risk of paying additional premiums in the future. With that said, the risk of paying additional premium calls can be mitigated by using a structure like a private placement. Each investment structure and each policy purchased in a portfolio possesses differences that will change the potential yield on the investment. A solid low double-digit return is achievable utilizing conservative life expectancies, purchasing policies at a discount, and controlling fees on the front end. This will depend on the actual investment structure. Again, illiquidity is based on the structure of your life settlement investment. Each will vary, but typical liquidity or payouts occur as policies mature and assuming cash reserves are met for future premiums. As the life settlement industry continues to grow, more regulation and oversight will also continue to grow. Working with well-established companies with a track record of client success is always recommended. Lastly, it's important to remember investors are truly helping the seniors who are liquidating an asset most didn't realize had any value whatsoever. There's no disagreeing this is a win for the insured and a win for the investor. It's important investors can clearly evaluate, manage risk, and avoid potential pitfalls when investing in life settlements. Just like in any industry, there are life settlement companies that have come and gone. So investors should work with a company with a history of client success and a high level of transparency. Taking these steps will reduce risk exposure. You also want to work with a company that has a proven track record and uses the experience of licensed third-party providers and servicing companies to ensure policies pay out. Companies with anything less than 100% payouts on maturities should be avoided. This is a sign of poor underwriting. A company purchasing a policy or group of policies on your behalf should buy the policies at a deep enough discount where the policy remains profitable for 8 to 12 years after the purchase. Don't hesitate to ask the company you're working with to supply you copies of the policy illustrations showing the ROI by year. We discuss premium calls a number of times here in this presentation. The key is understanding which structure is best so you can determine how the premiums will impact you. When discussing an investment opportunity, we definitely want to know what types of returns are realistic. Based on a life settlement industry study by the Harvard School of Business in 2013, they found investors experienced an average return of 12.5% on their life settlement investments over the studied 2001 to 2011 sample period. A solid low double-digit return is achievable utilizing conservative life expectancies, purchasing policies at a discount, and controlling fees on the front end. Keep in mind, unlike a mutual fund where everyone experiences a similar return, the return will vary with life settlements among individual investors and based on the actual structure of the investment. As I mentioned at the start of this presentation, our goal was to turn your interest into knowledge. Now, the strategy of investing in life settlements is a strategy you know, or at least you're heading in that direction based on the education you just received. Your slice of investment knowledge just got a little bigger when it comes to the asset class of life settlements. If you would like to learn even more about life settlements, please contact the financial professional who referred you to this educational presentation. They can answer any additional questions and help determine if this strategy is right for you.